Hey everybody, this is Jim at sp500chart.com. It is June 23rd, 2013, and we're going to take a look at the week ending June 21st, and also what took place on Friday to try to get a little sense out of where the markets may be headed. And we, of course, we use the S&P 500 pretty much as our benchmark or our bellwether, since it seems to be I think the best mix of stocks, just to get an overall sense of direction. So before we do this, I just want to remind you, as always, that the website and the video are for educational purposes only, and nothing stated at the site or in the video is intended to be used as investment advice. I can draw lines on charts, but you have to draw your own conclusions from your own research and make investment decisions that are suitable for your personal financial situation. I am not a licensed financial professional. I'm just a guy who draws lines on charts. And I want to welcome new subscribers. Thank you for joining in on the fun. The first thing I want to say is, by the way, if you join over a weekend, I want you to remember that if you sign up on a Saturday, your 2-week trial ends on a Saturday. So if you don't like what you see, you need to cancel before that. But I do not start your subscription as far as when I would cancel it. I don't take those 2 weekend days away from you, because if you sign up on a Saturday, you're not getting anything that anybody else can't also get. So your subscription actually starts on Monday. But the 2-week trial does start on Saturday, because that's out of my control. So anyway, let's get into the chart. Okay, we're starting out looking at a 30-minute chart, and here's our quick overview. The S&P had been just in a tremendous uptrend since the middle of November of 2012. We came up and peaked at almost 1690. Then we started to sell back down. We really formed something of a slightly oddly shaped head and shoulders top that formed basically in the first half of this chart. Here's our little growth stunted left shoulder, a head, and then two right shoulders. A strange looking pattern, and you'll recall we were looking at this as potentially a head and shoulders, but also kind of like a triangle. And honest to goodness, it didn't make any difference, because you still measure where it's expected to go from the same spot. Okay? And when we got down to this 1598, that was pretty much close enough to call it being a done deal. But now, with this move down to 1580, for sure, without a doubt, the overhead selling pressure that was built up in this pattern was this move down here is clearly enough to have relieved that selling pressure. Now, we calculate minimum moves. We don't calculate maximum moves. There's no way to know what a maximum move could be. I'll remind you that the 2007 top, I think that head and shoulders top probably had a target of 100, 120 points, which at the time it formed meant, I'm going by memory here, so this is just use this for illustrative purposes, meant that we would be looking at a top that would say, well, the S&P is going to go down to 1,300 minimum. Well, it went to 666. So I'm not saying that's what we do here, but I'm saying keep in mind, minimum means just that, minimum. Now, here's something that's kind of interesting, and this is what I alluded to in the forum in a post I made. When we came down and we started down in this channel defined by these two parallel lines, we bumped up out of this channel, came back down underneath it, then got back over it again, and it sort of looked like the S&P wanted to firm up and maybe try a reversal here to go up to a new high. And we knew to watch this line or this line with the idea that whichever one of these lines breaks, we would see a move of approximately 48 points. based upon the height of this pattern. So if we break up, we would expect to move to about 1700, and if we break down, then we were expecting a move to about 1572. And that's where we broke down, and there's our target. Now, I'm going to throw a little monkey wrench in our process here, and here's why I'm doing this. When you have a line that is defined by two data points, and this lower line only had two lines to define it, one being the June 6th low, and the other one being the low of June 12th and 13th, kind of shared there. And if we zoom in, you can see that this actual little candle right here that was put in, yeah, I'll be honest with you, I can't tell if that was a closing candle. I believe, no, that isn't. I believe that's an opening candle here. So what I'm saying is we had this little move that happened very early in trading on the 13th, and I'm not absolutely positive that, what's a good way to put this? Let's just put it this way. It would have been a lot nicer if we'd had two more touches on this bottom line instead of just these two. And the reason is because if, for example, we move this line to right here, now all of a sudden we have a slightly, we still have roughly the same target, not quite as much. Okay? But where we break down from, you can see with that slight alteration in that line, where we break down from on the 20th, you can see that what took place ensuing on the 21st and on the 20th and the 21st, just with the slight movement of this line to there, all of a sudden now the minimum from this target would have been met. And the reason I throw that out is because it looks like we may be forming a little bottoming pattern here. And if that's the case, then this move to about 1578 or so, that would be low enough to meet that minimum target. But again, we have to fudge just a little bit on this second data point. And I've been around long enough to know that things don't always match up exactly, and sometimes you do get moves slightly above or slightly below trend lines. And I've been around long enough to know that often those little false moves, well, not false moves, but a lot of times those little out of bounds moves will take place at either an open or a close. So all I'm saying, that was a long way for me to say that what we saw last Friday may be good enough to satisfy this little pattern that we had going on here for about 2 weeks. Now, am I saying this is a bottom? No. But what I'm saying is it looks like it may be a bottom. And here's why I say that. First thing is, I made mention of this in the forum last week, to watch the futures, because the S&P futures had actually, from this top portion up here, had actually formed a very well-defined descending channel that was parallel. The actual cash market here did not do that. The futures did. Okay, so that broke, but they share the same resistance line. That broke out on the open on Friday morning. Then we also have a series of little peaks and valleys that formed from pretty much the beginning of trading on the 20th all the way through about half the day on the 21st, and that kind of broke out a little bit and came back for a back test. You see where I'm going here, don't you? Additionally, we had another go at, or at least another 2 tags on that 1598 level that we know is technically important for a number of reasons. So what I'm saying right now is we got 2 things to watch, I think, coming into trading on the week that will start tomorrow on the 24th. The first thing is there's a potential bullish pattern, and that bullish pattern could be an inverted head and shoulders, and this would be where it is. Now you say, well, but that's a small pattern that would only take the S&P up to about 1620. True, but we've seen small patterns like this kick off significant legs in the markets. So I'm open to that idea. But then there's also a potentially bearish pattern, and this would be defined by these 2 lines right here, and that would be that this swift downtrend recovers only to set up a bear flag, in which case the bear flag would break down and we would likely come down to get all the way down to my original target at least, and probably down into the 1550s. The good news is this. The good news is we have 2 lines that are within 10 points of each other, or even closer, that should help us know which way this is going to go. The first one is this line right here at 1600. Let's call it 1600. If this is an inverted head and shoulders, this would be the neckline. If the market rallies up to 1610, 1612, then it's likely going to rally on up and at least touch this green trend line up in the 1630s. If this breaks down, then we're going to head back down. Could get a bounce here on this red line, but I kind of think that any breakdown at this point of a bear flag should bring about more selling than just another little retest of the same lows that we saw on Friday. A bear flag should bring about something significantly lower than that 1578. So coming in to Monday morning, we've got 2 levels to watch. We've got this level here at about 1592. It's rising. If that breaks, then be on the lookout for some selling pressure to pick up. If, on the other hand, we break 1600, then I would look for a move up to the 1630s, where likely there would be some resistance, and the resistance would come in the form of a couple things. The first thing would be we would be hitting this line right here for a back test. Since that broke and there hasn't been anything close to a back test on this line, that should provide some resistance. Second of all, we would be coming up to gap resistance. Remember, we've talked about gap support and gap resistance. Excuse me. Gap resistance would be where the people who are blindsided by the gap down on the 20th may be seeing, gee, if the S&P just makes it back to 1630, I want out. So I would expect resistance at 1630 if this does head higher. So how did we do for the week? Well, I think the week was kind of so-so. I believe we had a pretty good plan coming into the 17th, and that plan was to first examine this lower line. If this line breaks right here in this, well, I take it back. I do take it back. We did not get this line on the chart until Tuesday, I believe it was, or it might have been after the close on Monday. But let me put it this way, before this line broke down, we had identified it. And I believe what helped us to identify it was this low that was set and then the ensuing bounce on Monday afternoon leading into Tuesday. So early in the week, we identified these two lines that look kind of like a descending wedge, with the idea that upon reaching this green line, there is likely to be some resistance, and could the S&P overcome that resistance and stay within this line, between these two lines, for long enough to challenge some highs up in the 1670s? And the answer to that was no. I really was also where I think I probably the biggest error of the week was in expecting a bounce down here in the 1620s. I really was expecting at least one more turn inside this these two green lines right here. I thought we would get the here we rally up, bounce, rally up. I thought we would bounce one more time before potentially taking this line out. It just wasn't to be. So this line getting taken out on Thursday came as a surprise. But once it broke down, we knew to expect some pretty significant selling pressure, and indeed we got it. Our first clue was the breaking of this line, at which point I thought we would bounce here. But when that broke, then we knew that there would be a price to pay for that. Now, I thought also, admitting it freely, I thought we could bounce at 1600. And we tried to twice. But eventually when 1600 broke, you could see now that 1600 line has been serving as resistance. Coming into this week, let's see if the S&P has the steam to attack this 1600 line again and get up to about 1630. That would seem to make sense to me. But it's got to get over that line before we would expect such a move, and that should be the trigger that would kind of culminate that move, due to what would be an inverted head and shoulders pattern. And again, we've got a couple broken resistance lines that took place on Friday as well that make that a fairly decent possibility. So coming into Monday, I'm keeping an open mind. Either we take out 1600 and head up to 1630, or this is a bear flag and we take that out and we head down, likely to test something in the 1560s or high 1550s before it's all said and done. So I'll be honest with you, kind of a mixed bag this week. Again, I feel like I think we had all our little fences and all our little boundaries and all our lines. I think we had them in the right place, but what came as a little bit of a surprise was not getting a bounce here. That was the one thing that I found frankly a bit surprising. So I will call this past week a mixed bag. And again, just to reiterate, coming into the week of the 24th, we're watching the potential bearish scenario that we are seeing a bear flag developing between this support line and this resistance line. You can see that's got a little bit of a wedge-ish shape to it, which kind of makes it look a little suspect. If you're a bull, you need to watch this, but at the same time, watch this 1600 line. If you get up over that, then I think 1630s. So, gosh, again, I wish I could say we are in between patterns. We've broken out. Now we know what to look for. But the fact of the matter is we're not. With the adjustment of this lower line in that consolidation area, if you think that's a good place to consider where that line should be, then that means this could be a short-term or intermediate-term bottom. So let's go into Monday with an open mind. 1600 resistance if it gets taken out, 1630, or bear flag, and if this lower line gets taken out, then we would be looking for 1560s to high 1550s. Hey folks, thanks for watching the video. Thank you for your support, and take care.